A few of you recently reached out asking for a complete zero-to-hero roadmap on how to start algorithmic trading and actually reach consistent prop firm payouts. So today, that is exactly what we are covering. The reality is that over 90% of retail traders fail prop firm challenges. And despite what most YouTube gurus tell you, it's rarely because their strategy completely lacked an edge. It's because prop firm rules are designed to exploit human vulnerability, trailing drawdowns, tight daily loss limits, and emotional revenge trading after a few losing trades. Switching to algorithmic trading removes human emotion from execution. But here is the hard truth. Coding a single expert advisor and running it directly on a challenge account will still get you blown up. Passing a prop firm challenge with automated trading isn't about finding one holy grail bot. It is an engineering process that requires strict quantitative validation, portfolio diversification, and dynamic risk management built directly into the code. In this video, I'm giving you that complete step-by-step roadmap, from formulating a market hypothesis to coding and stress testing your EA in MQL5, building an uncorrelated portfolio, and setting up the exact money management math required to reach consistent payouts. Let's dive in. Step 1 is where most beginner algo traders make their first fatal mistake. They stack 5 different retail indicators, like RSI, MACD, and moving averages, and hope that combined, they create magic. That's not a strategy. That's indicator noise. To build a robust expert advisor, you must start with a clean, quantifiable market hypothesis based on structural market behavior or institutional mechanics. Here are 2 proven examples of market inefficiencies you can model. First, Asian session mean reversion. During the Asian trading hours, market volume on European currency pairs like Euro-USD or Euro-GBP drops significantly. Prices tend to bounce predictably within a tight range before the London Open. Second, session open momentum breakouts. When major financial hubs open, like London or New York, a massive surge of institutional liquidity enters the market, often creating directional momentum on instruments like gold, NASDAQ, or USD/JPY. When formulating your hypothesis, follow the principle of parsimony. Keep your entry rules as simple as possible. If your core edge requires more than 2 or 3 logical conditions to trigger an entry, you aren't discovering a market pattern. You are just fitting code to past noise. Once you have a clear hypothesis, you translate it into code. Whether you write it in MQL5, use AI assistance, or build it visually. But turning an idea into code is only 20% of the work. The remaining 80% is stress testing. If you optimize an EA over 10 years of data and get a perfect upward-sloping equity curve, you have not built a profitable algorithm. You have overfitted it. Curve-fitted EAs look amazing in backtests and collapse the moment they hit live market conditions. To make an EA prop firm ready, you must run it through a rigorous validation pipeline. First, tick data quality. Always backtest on 99% real tick data with variable spreads and realistic execution slippage enabled. Fixed spread backtesting is completely meaningless for intraday strategies. Second, in-sample versus out-of-sample testing. Divide your historical data into 2 segments. For example, use data from 2018 to 2023 as your in-sample set to optimize your parameters. Then, test those exact parameters on out-of-sample data from 2024 to the present. If the strategy performance breaks down on unseen data, reject the EA immediately. Third, Monte Carlo simulations. Run Monte Carlo analysis to stress test your system against worst-case scenarios by randomly reshuffling trade sequences and historical spreads. Your goal is to verify that even in the worst sequence of trades, your maximum drawdown stays comfortably within your threshold. Here is the secret used by quantitative funds that retail traders completely ignore. Never trade a single strategy. Every single strategy goes through market regime shifts. A trend-following strategy will suffer drawdowns during choppy market consolidation. A mean reversion strategy will get hammered during strong trending news events. If you put all your risk onto one single EA during a prop challenge, a bad regime week will hit your daily loss limit and fail your account. The solution is building an uncorrelated portfolio. Instead of risking 1% on one EA, you divide that risk across 3 or 4 EAs that operate on completely different assets, timeframes, or trading logic. For example, System A could be Asian mean reversion on Euro Pound. System B could be session open momentum on US dollar Japanese yen. System C could be a trend-following breakout on gold or NASDAQ. To verify your portfolio, check the mathematical correlation between the equity curves of these strategies. You want a correlation coefficient below 0.3. When strategy A is in drawdown, strategy B or C takes winning trades to offset those losses. This slashes maximum portfolio drawdown by 40 to 50% and keeps your daily equity curve stable.
Now let us talk about the exact mathematical framework needed to survive prop firm rules. The biggest trap traders fall into is misunderstanding account leverage and drawdown limits. If you buy a $100,000 challenge account with a 5% maximum daily drawdown, you do not have $100,000 in capital. Your actual operational capital budget is $5,000. If you risk 1% of the nominal account balance, which is $1,000 per trade, just 5 consecutive losing trades in a single day will instantly blow your challenge.
To protect your capital, adjust your position sizing based on your maximum daily drawdown budget. Risk no more than 0.25% to 0.5% of the nominal balance per trade. Position size should be calculated dynamically based on stop-loss distance. Also, implement a hard-coded daily equity cutoff. In your MQL5 codebase, write an equity monitoring loop. If the daily account equity drops by more than 2.5% or 3% from the start of the trading day, the script must automatically close all open positions, cancel all pending orders, and disable trading until the next daily server reset. This guarantees you will never breach a daily drawdown limit due to runaway market slippage or emotional decision-making.
The final step is operational deployment and transition into regular payouts. First, never run prop firm algorithms from a local home computer. Internet outages, power losses, or high latency will eventually disrupt your order execution. Host your EAs on an ultra-low latency virtual private server located close to your prop firm broker server, ideally with execution speed under 5 milliseconds. Second, account for high-impact economic news. During events like NFP or CPI, spreads widen drastically. Integrate an automated news filter into your EAs to halt new trade entries 30 minutes before and after high-impact news events.
Third, adjust your risk profile based on account stage. During the evaluation phase, use a risk profile of 0.5% per trade to achieve the profit target efficiently. Once funded, cut your risk per trade in half, down to 0.25%. Your primary objective shifts from rapid growth to capital preservation, enabling consistent, low-stress biweekly payouts. When you treat prop firm challenges as a quantitative engineering pipeline, you turn passing challenges from a high-stress gamble into a repeatable process. That is the full algorithmic roadmap to prop firm payouts. If you found value in this breakdown, hit the like button and subscribe to the channel for more videos, strategy builds, and MQL5 development. Thanks for watching, and I'll see you in the next one.